Welcome back to Navigate Your Wealth, where we are discussing today the importance of being truly diversified. Do you know if you are properly diversified with your investments, with your money? Is it doing all the jobs it needs to do in order to have a solid plan in place so that you can be confident that you will not outlive your money? Because at the end of the day, that's what people are concerned about, right?
Absolutely.
They just want to know that they're going to be okay. It's interesting because in this topic of diversification, I think one of the common misconceptions, you mentioned this at the beginning of the show, Karen, a lot of times people say, well, I've got all these different CDs at all these different banks, so that means I'm properly diversified, right? Or I've also heard and seen folks who have multiple mutual funds, and they think they're properly diversified because they've got their money scattered in these different places, right? But if someone is diversified from an asset class perspective, and if they're diversifying their risk in that way, is that really enough?
No. We really believe that just diversifying your asset classes is not going to create that successful retirement that we know you're hoping and planning for. The one diversification that we haven't discussed yet is tax diversification. You know, when most people first start saving, they contribute to the 401k in their company. And that is an incredible resource that exists because if they didn't have the ability for out of sight, out of mind, most people would have nothing. But there is problems with that direction of thinking.
Well, and the problem with the thinking, Samantha, is that if 100% of your money is in the qualified plan, which I hope it's not, you know, your 401k should not be the sum total of your retirement planning, okay? It's one component, and it's great that the company offers it. First rule of financial planning is take the free money, yada, yada, yada. But the bottom line is if 100% of your dollars are in qualified accounts, then when you retire, 100% of your income is going to be fully taxable. Now, some people would say, so what's wrong with that? My income is 100% taxable. And I would answer, if there was a better way, would you want to know it?
Well, and I love that you're talking about tax diversification because, you know, we say this on the show at least once every week, I feel like, but it's so true. How you make a decision in one area of your financial life can and will affect all the others. You can't afford to not look at how these pieces all fit together because there's opportunities to create greater tax efficiency throughout your full financial plan, and that's why you need that diversification from a tax perspective as well.
Absolutely. And one of the things, you know, with the 401k being an option at companies, a lot of companies are now offering a Roth 401k option. We are huge proponents and advocates for looking at your tax diversification and taking the free money where you can get it. So if your company is offering a Roth 401k option, take that. Listen, I know you are not going to get the tax diversification or the tax deduction today. You are going to pay the tax on that money. But now that money is growing 100% for your benefit and not for the government's. Now, the match on that money is going to go into the 401k side, which means that in the future, you will have to pay the tax on it. But still, it's free money. Take it.
Exactly. We don't ever want to leave it on the table, no matter which bucket it's falling into, right?
That's right.
Now, if your company does not offer a 401k Roth
option, right,
then we want to look at outside of the free money match, what can we do with those dollars?
And Sam, we say outside, and I want to clarify. To have a successful retirement, we have done the numbers a million times. If you are not saving 20% of your gross wages, now for those of you who are very close to retirement or in retirement, tell your kids this. They need to be saving 20% of their gross wages every single year. The numbers work out, you're going to be able to retire. So the first thing is if you have to put in 6% to get the company match, that's 6, but there's still another 14, and that's what you're referring to. Outside of what you put into that 401k, now in this scenario, the extra 14%, there's other options.
Yes. Yeah, go ahead.
No, so the two options that really exist that we would recommend with that 14% would be to do a Roth option if you have the ability to. If you are still working, you have Roth contribution limits, but If you are within the limits, making that Roth contribution could be a great option for your savings. The other option, maybe you've exceeded the Roth contribution limits, is to consider cash value life insurance. When you have a permanent life insurance policy, we like to call it the Roth IRA on steroids. It has all of the same benefits of the Roth, plus more.
And so let's talk about that, because I think, you know, we've unpacked this. I know we did an entire show a couple of weeks ago on life insurance, how you all look at this differently. And I think that's really powerful. I mean, to call it a Roth on steroids, that's huge. So explain what you mean by that.
Well, it is. So a Roth IRA and life insurance have similarities. Obviously, they're funded with after-tax dollars. They grow tax-free, and withdrawals are tax-free. And that's where the similarities begin and end. With life insurance, you have so many other benefits, which is why we say it's on steroids. You have an immediate death benefit if, God forbid, you put one premium in and die. They're paying the whole death benefit. But let's talk about the living benefits. You have access to that cash value in a much different way than you do in the Roth IRA. Because the Roth IRA, the premiums need, or the contributions need to have stayed there for 5 years, or at 59 and a half when you can pull it out. Life insurance, as soon as the cash value is there, you can pull it out. But before going into too much more of that, let me give you an example. We call it the 2 bags of money story. If you have the opportunity to retire with $100,000 of income, and all you've ever done is a 401k or an IRA, all of your money is in qualified accounts, then that $100,000 coming out in today's world is going to land you about in the 25% bracket. So to keep things really simple, we're going to say you earned $100,000 of retirement income, you paid $25,000 to the government, so you have $75,000 to enjoy. And if you don't know any different, you're going to say, I have $75,000 of after-tax income.
Right.
The second side, we did tax diversification. So now we're going to take $50,000 out of the qualified account, because you are going to have some qualified money, and that's going to be taxable. But now that $50,000 in today's world may only be taxed at 15%. So instead of paying $25,000 to the IRS, I'm only going to pay $7,500, leaving me with $42,500. Now, I'm not going to live on that. I've got another $50,000 because I did tax diversification. I'm going to take that other $50,000 either from the Roth IRA or cash value life insurance. That $50,000 taxed at 0 leaves me with the full $50,000. Now, I want to do the math here. In the first scenario, you earned $100 and ended up with $75. In this scenario, you had $50, ended up with $42,500, and another $50, and ended up with the whole $50. That's $92,500. Please take your time before answering the next question. Would you rather have $75,000 or $92,500?
I'll take the $92,500. I don't need a second to think about that, right?
And that is diversification. Again, everybody talks about asset diversification, stocks, bonds, yada, yada. But tax diversification is critically important as well.
It is.
Mom, I want to challenge you with a question, because I think some of you at home might be thinking this. If I pay my tax now, I have a smaller amount that is being invested, and that is growing. So what would we say to those people that think, I don't think this is the right strategy?
Yeah, we've actually had to prove that out a number of times. What Samantha's talking about is if you have $10,000 that you can put into your 401k or qualified plan, you have the whole $10,000 going in there. On the other hand, if you only put $7,000 into the Roth IRA, you only have $7,000 in there. So basic math tells you that $10,000 every year for so many years may grow to $1 million, where $7,000 every year for the same number of years at the same rate of return would only grow to $700,000. Here's the question. Who has more money, $1 million or $700,000? Whose account is bigger, Kristin?
Well, the $1 million is bigger, right?
Except what?
Except what? It's
not yours.
Right, it's not yours. You don't own all that money.
That $1 million is a joint account with the IRS. And the only way you have a chance to get more money out of that account is if you're in a lower tax bracket when you retire, which was the promise when you put the money in. Oh, put the money in now. You're in your highest earning years. You're going to be in a lower tax bracket when you retire. The problem with this scenario is it's not happening. We are at the lowest tax base in history. Taxes are only going up. This is why tax diversification is so critically important, and why at Compass Financial we spend so much time helping our clients understand how to get the biggest bang out of every buck.
Absolutely. You know, I love that story. I've shared that in a live event situation before. And when you help people understand that, let's say you have that $1 million, that money is not all yours, people get angry.
Yeah.
And then until you have to illustrate, no, you have a silent partner who's going to become not so silent. That's Uncle Sam. This is why you have to engage in that strategic tax planning. Well, one of the things, I know we only have a couple minutes left in today's show, we've been talking about being properly diversified. We've talked about diversification across asset classes, being properly diversified from a tax perspective. One of the things I so appreciate about the two of you at Compass Financial is you both provide a diversification of perspective. Share a little bit about that, because between your combined years of experience, being in different age demographics, you're able to help so many people in such a relatable way.
Well, for those of you that don't know, I promised my mom that I would join her at age 11. It took me a little bit of time, but really us coming together and working together gives our clients a new perspective that a lot of financial firms don't have. Traditionally, a client base and an advisor are very mirror image of one another. So most clients reflect the age, demographic, etc. of the advisor. Because there's two of us, there's a few benefits that are brought to the table. One, there's two of us listening to you in a meeting. So when you come and you meet with Compass Financial and you're sharing your hopes and dreams and mom's telling stories, I'm sitting here listening to you and what you're looking for. And when I'm sharing examples and stories, mom's looking at your body language and saying, do they understand what is happening? Do they understand what Sam is asking for? But also, I'm her exit strategy. So when you work with Compass Financial, we're here for the long haul. We are here to see your retirement to the end.
Wonderful. Sam and Karen, it's always a joy. Thank you so much. And we thank you for joining us. Again, we encourage you to pick up the phone and call to get on their schedule so that you can receive your complimentary retirement roadmap. 855-348-3073. Be safe, be happy, be blessed. We look forward to being back with you next time on Navigate Your Wealth.